Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. The U.S. ambassador to Canada says Canada and the U.S. have a chance to reach an agreement to reduce tariffs despite last month's diplomatic blow-up. Ambassador Pete Hoekstra told a conference in Ottawa the talks will resume, though he's not sure when. U.S. President Donald Trump halted negotiations in October after Ontario Premier Doug Ford ran an anti-tariff ad featuring former U.S. President Ronald Reagan. Stella-Jones is one of the best performing stocks on the TSX today. That after the Canadian Wood Products Company introduced new three-year targets. The objectives include organic sales growth of up to 5%, profit growth of more than 10%, and a goal to reach about $4 billion in annual sales by 2028. And see the new targets as an encouraging sign for expansion. Not surprising, shares of NVIDIA are rallying after it posted profit that topped estimates and revenue. It's up about 3.8% right now. The surge was about 62% in the latest quarter. The chip giant also issued a strong sales forecast, pushing back on fears that the AI industry is in a bubble. CEO Jensen Huang also signaled that the $500 billion revenue target due in coming quarters may be even bigger than anticipated. NVIDIA faced growing fears in recent weeks about unsustainable spending on expensive AI equipment. And taking a look at the markets, they are reacting to the NVIDIA news. Tech is driving things forward right now. You can see the TSX up by 0.76%. And in the U.S., similar situation. Let's see what's happening down there. Yeah, there you go. S&P 500 up by 1.43. Dow Jones Industrial up by 1.1, 1.2. And the NASDAQ's up by 1.85%. NVIDIA's sales of the computing chips powering the AI craze surged beyond the high bar set by stock market analysts. We're joined now by Teresa Schutt, Chief Investment Officer at Harborfront Wealth Management. Teresa, thanks very much for joining us.
Thank you for having me. It's great to be here.
I guess a collective sigh of relief from many people today with the numbers that NVIDIA put out.
Yeah, absolutely. I mean, the growing concerns about the possibility of this AI bubble led to this recent wobble in equity markets, as we saw, but it seems to be soothed by the recent results of NVIDIA. And obviously, based on the market's reaction today, like the strong performance is expected to reignite the tech rally, particularly as the fundamentals underlying the revenues remain strong. This tech bubble that everyone keeps talking about, obviously there are some similarities between the late 1990s and the current AI boom. But, both periods did, yes, push valuations to new heights. But in the late 1990s, the dot-com boom, investors poured their money really into more speculative internet-based companies, while telecom firms took a massive debt to build out the fiber optic infrastructure. So this is really different. Like the bull market is being led by companies that are highly profitable with diverse revenue streams. AI investment has been, made through internal cash flows, not debt. And while elevated, the valuations really aren't as extreme as they were in 2000, with profits, really driving the rally instead of hope. So I think there's, as many say, it's still the early innings of the AI revolution. The applications of AI are obviously vast. We're seeing, my company's investing huge into AI. I think it's only the beginning. And while there are concerns about, data center capacity and power, I think these things will resolve themselves because that computing power, the demands of that computing power are huge. And so the demand for these chips are going to continue to grow. That said, NVIDIA does have some potential headwinds. They are restricted from selling those GPUs into the U.S. They've got, some concern over whether hyperscalers can actually put the capacity to work fast enough. And then obviously, there's always that, concern about this circular AI economy, which is, is there this mirage of growth just because they keep investing in each other and it's become more and more insular? But I believe the headwinds are extremely strong. So I think this is just going to continue at least for the next quarter.
Sorry, and you think the headwinds are strong or the
Oh,
tailwinds?
sorry, tailwinds.
Tailwinds are strong. Okay.
Tailwinds.
Just wanted to clarify on that. I just want to
Yes.
did you see the Barclays report today where they say that there's no turning back on AI now, and it's going to be the macro factor in 2026 ahead of monetary policy, trade policy? Is that reaching for the sky, or is that a realistic assessment?
Well, I think, there's always the saying, Wall Street's not Bay Street, or sorry, Wall Street's not Main Street, or Bay Street's not Main Street. So I think what happens in the markets, doesn't always reflect what's happening on the ground. We still have, in the US, a lot of lower income households that are, increasingly frustrated about high inflation, lower incomes, slow job hiring. Obviously the wealthy are doing well. They've accumulated a lot of wealth through equity gains. So that kind of bifurcated K-shaped economy, so really everything looks okay at the 50,000 foot level, but, down below, I think there is more things happening. And I think that doesn't reflect, what we're seeing in the equity market today. So I think it's a macro factor, and that obviously contributes to economic GDP growth, productivity gains, obviously increased wealth. Everyone with a retirement fund has access to NVIDIA and the tech sector. But I do think if you looked, in different sectors of the economy, you might see a very different narrative.
Okay, and that's a good time to turn to Walmart earnings coming out today, and
Yes.
also that they're moving to the NASDAQ. I just want to get your thoughts on that first.
Yeah. Yeah. So very interesting. Obviously they had a strong quarter. And I think, everyone was sort of watching them closely, because, going into the holiday season, are people spending? Because if you look at consumer sentiment numbers, they're actually declining. But apparently, they are pointing to a strong Halloween and early Thanksgiving sales season. They're optimistic about, that the holiday events coming forward. Online sales were a bright spot, and 28%, climbing 28%, driven by groceries. And what's interesting is in their earnings call, they mentioned that this is really because of upper income households that are cashing in on the convenience of these faster deliveries. So these expedited deliveries, which rose 70% in the quarter. So I think this is something that's interesting, because Walmart can kind of appeal to both income strata. So low income, obviously, and high income. They also saw an increase in, furnishings, home goods, things like that, again, driven by high income households. And this decision to move to the NASDAQ, I think really, kind of underscores how deeply technology is now embedded in the company. So more than 40% of Walmart's new software code is now AI generated. And then obviously they've spent decades investing in automation, e-commerce. They're using agentic AI. So I think, maybe they want to just be considered another tech darling and get the benefit of that. But I do think, they are becoming more of a tech company. And I think for them, it makes sense. So I think this is an interesting development. We'll see if others follow. Yeah, it certainly is a new development.
And I just want to move in and look at Canada. I mean, we're talking about things, all things American right now, but what kind of an impact is all of that having on Canada? Where do we sit right now?
Where do we sit? That's a great question. Well, the Bank of Canada just, recently, made a couple of announcements, obviously, about the Canadian economy. And one of the things that they're talking about is productivity. And while their official mandate is price stability, in their words, we continue to be stuck in this vicious cycle of low productivity. And that's really, kind of impacting our income growth. It's impacting our labor productivity. And it's really due to that, lack of business investment. And the Bank of Canada itself is even pushing to lower the regulatory burden for these companies and increase competition. Unfortunately, Canada is exceptionally good at nurturing oligopolies, not healthy and strong competition. So, look at, airlines, banks, groceries, telecommunications, and even beer. So what we need to do better is, provide that environment and culture for more innovation, more entrepreneurship, and more competition.
Okay.
Like on a labor productivity basis, we're, I think, below Japan, among all G7 nations. So I think this is, something that we need to address. Hopefully the budget is some of those initiatives will address that. But I think for Canada, I think we will avoid a recession. But I do think there are definitely some weak spots in the economy.
Okay, we're going to have to leave it there. Teresa, thanks as always for joining us, though.
Thank you so much for having me.
Teresa Schutt is the Chief Investment Officer at Harbourfront Wealth Management. Up next, Cypher Mining, a leading owner, developer, and operator of industrial-scale data centers, is seeing a surge. We'll find out why when we come back. Let's take a look at some of the market movers today. We're joined by Bloomberg Equities reporter Monique Malima. Monique, thanks as always for joining us. And we've got a diverse mix today, and we're looking first up at Cypher Mining. What's going on there?
Hi, yes, thanks for having me. So Cypher Mining, they're a Bitcoin miner that is now going into AI data centers. And they announced this morning that they had extended their deal with FluidStack to now offer an additional 56 megawatts of AI hosting capacity. As a result of this deal, the expected revenues from this are going to be around $830 million. And this is in addition to the deal that they had announced earlier this year. And what's really helping these shares is that this partnership is being backstopped by Google. Google is providing an additional over $300 million for the deal today. And in total, Google's now investment will be about $1.7 billion. And analysts are seeing this as really a vote of confidence for this stock. This company in the data center space has really been able to capitalize on the growing demand that there is from artificial intelligence. And with Cypher having another about 3 gigawatts of power, they will be able to do even more deals potentially in the future.
All right, and Stella Jones, some news happening there. What's going on?
Yes, so Stella Jones, they announced their 3-year forecast this morning. They're expecting to see as much as $4 billion in sales by 2028. And this is something that analysts say is really encouraging. The company is expecting to see more growth in its utility pole segment and railway ties, and to see revenues and margins improving going forward over the next few years. This is something that some investors and analysts had somewhat been expecting, but are still saying that it's positive for the company overall. And as part of these announcements, Stella Jones also said that they're going to start buying back shares opportunistically. Previously, they had set targets for how much shares they need to buy back every year, and now they're saying that they're going to do it when the time is best and when it makes the most sense. And analysts are thinking that this is a better way of approaching it and may also open up opportunities for M&A going forward.
All right, now last but maybe least right now, Bath and Body coming clean about their numbers, not very good.
Yes, so Bath & Body Works, they reported their third quarter results today that were somewhat disappointing, but the big focus for investors and analysts today is their full year forecast. They cut their earnings per share guidance, citing lower consumer confidence. The consumer sentiment right now, they said, is really negative, so consumers are pulling back from their purchases. This is something we've heard from some other retailers this week, like Home Depot, that have warned that consumers are starting to pull back on some of their spending. Bath & Body Works, as a result of these kind of negative results, has announced that they're going to be doing a transformation plan for the company focused on revitalization. They're hoping to bring in more customers, newer customers, and younger customers. So that's going to be the main focus for the company going forward. Analysts are expecting that the fourth quarter might be a low point for the company, potentially even worse results than this quarter, but with the potential that maybe things can improve from there going into next year.
Okay, thank you for that, Monique. That's Bloomberg's Monique Malima. Up next, we'll break down Walmart's latest quarterly results as the company plans to move its stock listing to the NASDAQ from the New York Stock Exchange. Well, Walmart is raising its full forecast for the year after topping earnings in its latest quarter, but the company is also warning that prices will have to rise. For more, we're joined by BNN Bloomberg's Lindsay Biscay to talk about it. Lindsay, thanks as always for joining us. Walmart's making some interesting moves.
There's a couple of different interesting moves and news coming out of this third quarter release today. So we'll start with just the numbers to begin with. It was a strong quarter for Walmart. I think that's the news they want people to focus on for the most part, is a strong quarter, raising its annual outlook for the year, as you mentioned, with net sales expected to rise 4.8% or to 5.1%. Revenue was up 6%. That's $179 billion. That's up from $177 that was predicted by analysts. Same-store sales was up. Foot traffic even was up going into Walmart. So all around, a good news scenario for the third quarter for Walmart. But yeah, the company is warning that sales are going to have to, or the cost of things really, the prices are going to have to rise. And that is for the most part because of tariffs. Walmart, like so many other companies, has been absorbing the cost of tariffs for most of this year, trying to source products from elsewhere when they get too expensive, working with suppliers to try to keep prices low. But the CFO was saying that prices are going to be rising in the new year because, as we've heard so many CEOs from different companies saying, yes, they have been absorbing the cost of the tariffs, but they can only do that
and
for
they bought
so long.
ahead a lot and things like that.
Exactly.
And now they're running out.
That's exactly it. So that they had inventory from before the tariffs that weren't, priced with tariffs in mind. That inventory, as you say, running out. And so as they restock, it's going to come with a bit of a higher price in the new year.
Have they hinted what the prices might be?
They haven't hinted exactly what the prices might be, but they just say, there's a rise in costs, and they're going to try to keep that cost down as much as possible. But many companies are saying they can't do that forever in the meantime.
All right, and the other interesting. Sorry, you have
no. That was
okay.
it.
The other interesting thing, they're moving over to the Nasdaq.
Yes, this is the other interesting news. Moving over to the Nasdaq and expected to start trading on the Nasdaq by December 9th, with the current ticker symbol still in place. New York Stock Exchange maybe not incredibly happy with this news. You can see the Walmart stock there today. Yep. But this is a move that clearly shows the company wants to focus more on tech. No surprise, Walmart is another company incorporating AI into its platforms, teaming up with OpenAI and ChatGPT. So you can basically buy products through ChatGPT. And this really shows a focus when it comes to tech. Walmart has really been trying to ramp up their e-commerce shopping, and it's basically 20% up across the board on all markets. And when you think of Walmart, of course, you think of like good prices, great value is their brand. And they do still have those kind of better value items, but they're really trying to start marketing themselves toward a higher clientele, especially with their e-commerce kind of third-party shopping platform. So basically one example that I saw today that I could not believe is that you can actually maybe through that third-party platform,
what you're going to say,
buy a pre-owned Chanel bag.
Yes, I couldn't believe when I saw that.
Yeah, I can't imagine that, but that's how things are changing. And part of that also is, unfortunately, the CFO of Walmart said that they anticipate a slowdown when it comes to low-income shoppers, which has been such a big part of their market for the past couple of years. But low-income shoppers obviously not able to spend the same way that middle-class and upper-class shoppers are able to spend. And so Walmart really trying to readjust their clientele. We did speak with one analyst today who was talking a little bit more about how Walmart is trying to kind of appeal to everyone. Take a listen.
They're resonating across all income cohorts. The higher income, they've been gaining share for a while, and it's still doing really well. But even among the lower income, they're responding to the 7,400 rollbacks they're doing, really focusing on affordability and food and convenience and pushing across the entire organization from digital to in-store remodels, et cetera.
So for people who still want to go to Walmart, get their groceries, like you still can, and things should be reasonably priced, I guess. Grocery business still accounts for about 60% of U.S. sales. So Walmart keeping that in mind, but obviously really trying to expand elsewhere as well.
Okay. And Arkansas becoming a new tech hub?
Maybe.
Oh, interesting. All right. Lindsay Biscay, thank you for that. BNN Bloomberg's Lindsay Biscay. Now, for more on Walmart's results and future plans, let's bring in Jihan Ma, Senior Analyst for U.S. Retailing at Bernstein. Jihan, thank you very much for joining us.
Thanks for having me.
You heard us talking about Walmart and the year that was, the year that is shaping up. Let's get your initial thoughts on their earnings report.
Yeah, I would say there were actually some concerns going into today, especially given the broader consumer jitters, given the news that Doug McMillon, long-term CEO at Walmart, he announced that he was going to step down at the beginning of next year. That announcement came out last Friday. And people were trying to triangulate what does this all mean in terms of their reporting come this week. Of course, the stakes were high, and I think the market collectively breathed a sign of relief when they put out a pretty strong beat and raise this time around, and you're seeing that strong reaction in the stock price today.
But they did temper it, though, with what might lie ahead, the increased prices. How much of a concern is that?
I would say, well, overall, it's market-wide, right? With the tariff situation, prices will have to go up. We're seeing inflation, broadly speaking, going up. Now, the difference and the nuance there is that Walmart is taking prices less than overall headline CPI inflation, right? So their like-for-like inflation in their U.S. various category and segments are in the very low single digit, just over 1% range, versus overall CPI inflation in the around 3% range. So what that means is that Walmart is actually among the more proactive in terms of selectively investing in pricing, and that's enabled by their second P&L, the high margin alternative revenue streams like retail media membership, that gives them more flexibility. More flexibility in the profit line to reinvest in pricing, and that's also widening their price gap versus competition, which supports this whole share gain flywheel.
And I want to talk about, Lindsay and I were just talking about that. We're both fascinated by the fact that their online sales, they're trying to grow that, everybody is, but also that secondary market, the third seller market, and the fact they're offering like high-end bag Chanel purses and things like that. Is this a future they see for Walmart? Can they see that becoming a bigger portion of their sales?
Yeah, absolutely. I think that the 3P marketplace is very much an integral part of this whole e-commerce flywheel. And I do think it's a critical component of how they're appealing more to the middle to high income consumers, right? Historically, Walmart have benefited a lot in times of crisis when middle to high income consumers would trade down to Walmart purely for value. And then they'll trade back up when the economy recovers. In today's environment, you're seeing Walmart appealing to those consumers on a more structural basis, right? There's better in-store experience. There's a much more broader assortment on the 3P marketplace, and they're trying to turn around almost a cultural perception that Walmart is no longer this rundown grocery store. It actually can have higher end brands. I don't know if it's going to sustainably have Chanel on the 3P marketplace, but in that direction, right? More prestige, more mass premium brands on Walmart to turn around how people think about what Walmart stands for. And that opens up a much bigger TAM for them to appeal to.
And I just want to ask one last question about their move to the NASDAQ. Your thoughts on that?
I think to your earlier comments, it's very much Walmart seeing themselves as a tech company with a lot of the not just the e-commerce, but also the agentic AI, the partnership they're having with OpenAI. They're very, very much integrated into that future trajectory. I think it also helps from a retail ownership perspective, right? The Invesco QQQ fund, for example, now that I would imagine they can be part of, Costco to date is the biggest non-tech top 11 holdings in that space right now. And Walmart could potentially participate in that upside as well.
Okay, Jihan, thank you very much for joining us today. We appreciate it.
Thank you.
Jihan Ma is a senior analyst of U.S. retailing, broadlines, and hardlines at Bernstein. And still ahead, we'll continue our conversation on NVIDIA's third quarter results. Stella Jones is one of the best performing stocks on the TSX today. That's after the Canadian Wood Products Company introduced new 3-year targets. The objectives include organic sales growth of up to 5%, profit growth of more than 10%, and a goal to reach about $4 billion in annual sales by 2028. Analysts see the new targets as an encouraging sign of expansion. Northland Power is aiming to double operations, focus on core markets, and narrow its organization from 3 regional hubs to 2. The company will focus on an America's hub and an international hub. Northland says the shift is part of its updated strategic outlook for 2030. and is meant to simplify its structure and focus on resilience in the market. Shares of Palo Alto Networks are trading lower. The security software company beat estimates on revenue and profit in its latest quarter, but investors seem to be focusing on its decision to acquire Chronosphere for $3 billion US. Some analysts are noting concerns about the company's core performance and the risks that come from integrating multiple large acquisitions. And the NVIDIA effect continues, although the TSX only up by 0.24%. It's south of the border, though. We're seeing a surge. Tech stocks leading the way pretty much everywhere we look. And you can see S&P 500 up by 0.65, Dow Jones 0.59, and the NASDAQ up by 0.8. And most of that because chip giant NVIDIA reported stronger than expected third quarter revenue and profits, easing concerns about an AI bubble. NVIDIA, of course, the maker of the chips that are crucial for AI data centers. We sat down with Angelo Zeno earlier. He's a senior equity analyst at CFRA for his reaction to the numbers.
We saw them beat, I think, our numbers by about $1 billion, street numbers by about $2 billion for the October quarter. More importantly, they guided for the January quarter about $3 to $4 billion above our expectations. So it was really a good beat and overall good results from our perspective. Also, the margins was something that, it was something that investors were going to closely monitor, just given the promises that NVIDIA made earlier in this year, expecting margin expansion throughout the fiscal year. And we did get that. We got 73.6% here for the October quarter, guided towards 75% for the January quarter. We were a little closer to 74.5%. So margin expansion story is looking very nicely. And I think more importantly, they're expecting sustained margins here going into their next year. So, also important towards that profitability story.
Hi, Angelo. Thanks for being with us. We had just listened to a conversation or interview that Jensen had given yesterday. And I think one of the things he talked about is how where there was concern earlier in the year that there was a shortage of chips, for the increased demand that they were seeing. But he was now very confident that there are a lot of Blackwell. He's also very excited about their next phase of chips and the rollout of that. Can you speak to maybe the confidence or your view of the duration of this cycle and that the fact that they've got their next chips ready to go, from what it sounds like, into the beginning of next year?
Yeah, no, that's a great question. So, the constraints earlier this year, late last year, largely, from Blackwell had to do with the fact that this was a new architecture and it was a shift towards these large-scale rack solutions and something that NVIDIA had never done. The entire semiconductor ecosystem, hardware supply chain, nothing that they've ever done to this extent. So, a testament to them that this is they were able to kind of execute as well as they did, and we're now seeing that ramp really take fold here. And why you saw partly the upside that we saw. As you go into calendar 2026, Rubin will launch by, we think, mid next year, which is their next generation GPU. Rubin is based on the same architecture as Blackwell. Shouldn't be any sort of delays or hiccups, we think, from the Rubin launch. There might be other issues that we've got to contend with, maybe supply chain bottlenecks or energy bottlenecks. For instance. But that being said, as far as NVIDIA's ecosystem themselves, they should be there shouldn't be any issues as far as 2026 is concerned. And we know the demand is there from the cloud providers, just given what we saw out of Q3 earnings season. So the visibility, at least we think over the next 12 to 18 months, is extremely strong.
Now, Wang was asked about the power supply, and he kind of answered but danced around a little bit. Is that a legitimate concern, and could that upset the table a little bit?
I think it's a legitimate concern in the sense that we're actually seeing more and more cases of where, we're getting these shells, these data centers built, and it's, in some instances, it's taking a little bit longer than expected to actually get the supply or the energy to actually, get into those shells. To what extent we're going to see, further delays, going through 2026 and 2027 remains to be seen. How much support do we get from the administration in terms of helping to provide additional energy support, something that the Altmans and the even Jensen's of the world have basically commented on. Also remains to be seen. But there are constraints at this moment in time, especially in certain pockets of the United States. And, if it ends up being more severe than we anticipate, what could potentially happen is you could see an environment where certain hyperscalers or customers potentially, delay certain purchases, because there's no way that these guys can spend as much as they are and sit on a full shell here where they're not getting the energy. And if it's sitting like that for 3 to 6 months, it's costing them significant revenue, especially when you're going to have a next gen chip roll out 12 months thereafter. So all stuff to kind of take into account. But it is an issue. It is a growing issue, and hopefully it's something that's going to be manageable here.
Angelo, another question on one of the topics that's been discussed is essentially the depreciation of these chips and the duration and what degree should they be depreciated. And, if we're going from Blackwell to the next series already, have you given any thought to what you think depreciation curves should look like for these hyperscalers that are spending all this money? And is any of that sort of in flux right now with sort of the next sequence of chip coming out?
Yeah, I mean, a good question. I mean, the way we actually look at this is, these customers probably are being a little bit more aggressive than they should be in terms of the accounting of these GPUs. What I would say is, in an ideal world, you would want to see some sort of an accelerated depreciation where they're taking more of that depreciation up front, less so in future years, to better match the actual revenue trajectory that they're getting from these GPUs. Now, that being said, when you look at the hyperscalers and what they've got in their system, they continue to sell or rent out capacity for Hopper, which was their last chip. They actually, in some instances, are also they continue to sell their Ampere chips, which was initially launched, I think, in 2019. So you're talking about 5-6 years ago. Okay. So from that perspective, they are generating revenue, and given that we are in a supply-constrained environment, I don't necessarily think it's a huge issue at this point, but I do think they are being a bit aggressive.
That was Angelo Zeno, senior equity analyst at CFRA, joining us on The Street today, which was co-hosted by Braden Teich, partner and portfolio manager at Avenue Investment Management. Coming up, all eyes, as you just saw, are on NVIDIA. We'll continue our coverage of their most recent earnings results and how that is affecting the broader equity market when we come back. We are watching shares of NVIDIA today after the chip giant reported strong results, easing investor concerns surrounding the growth of a possible AI bubble. We got more on this and the market with Christine Tan, portfolio manager at SLGI Asset Management.
There was some nervousness heading into earnings yesterday, and also there's been a little bit more of a noise around whether AI overall is a bubble, and our view is a bit more nuanced than just an all or nothing. NVIDIA, certainly with their numbers and the commentary from Jensen Huang, was quite reassuring. He spoke about strong demand for Blackwell, but more importantly, he really emphasized that they've been managing the supply chain for Blackwell very well. If you recall, a few quarters ago, there was sort of some noise around, how quick that ramp up in production was going to be. So it's both sides, I think, that's sort of reassuring the market today. And he also highlighted what a good job a lot of the partners or the other players in his supply chain have been doing. So TSMC, SK Hynix. And so I think that's why you're seeing such a response to not just NVIDIA itself, but also the other companies that are within its, if you call it supply chain or value chain.
Sorry, what were the companies that you mentioned there, Christine? Give us one or two of them.
Yeah, he mentioned SK Hynix, he mentioned TSMC, there were a few others that those are partners that NVIDIA works with.
Right, and maybe we could have a quick look at AMD in a second, because of course they are seen as a potential rival in the high-end AI chip space, and this may be good news for them too if demand remains strong.
It really, NVIDIA remains the leader in terms of the most advanced, but theoretically, you're right. As the demand broadens out, you're going to have applications that don't necessarily need the most advanced, and AMD certainly could benefit from that, being an emerging player or a secondary player.
It sounds like, though, you and your team, you're not fully sold on AI. You're not going hell for leather into these stocks.
So our team ourselves, we don't select the stocks for the portfolios. We hire managers to do it for us. However, when you look at our underlying equity managers, your assessment would be correct. So they do believe that the capital spending and the emergence of AI and the need for more compute, and just we're still in kind of the early stages of figuring out how to monetize it. Whether it's agentic AI or some of these larger language models and inference computing, et cetera. So they do believe in the overall technology. And there are certain core companies within it that are real players with strong cash flows and good balance sheets and a very strong competitive moat around its business model. I think where there's a bit more caution is around some of the smaller players or perhaps some of the more specialized players, where there tends to be a bit more excitement because they are so specialized and valuations can get a little bit extended. So overall theme of AI, believe in it, just cautious around valuations and making sure that you're sort of positioning in where there's substance.
The TSX, you guys or your team reckon that the TSX was cheap relative to US stocks at the start of this year, but the discount has narrowed somewhat.
Correct. So TSX is still trading at a lower valuation, around 16 times forward consensus, versus the S&P at about 22 times forward consensus. Having said that, S&P typically trades at a higher valuations because there's more tech and higher ROE businesses. Canada, we do have more cyclical sectors like energy and mining. So at 16 times, kind of in line with historical valuations, coming into 2025, the TSX was inexpensive relative to itself. So our view is we are still slightly bullish actually on equities, both TSX and the S&P 500. We are aware that valuations are fair for the TSX and a little bit extended for the S&P. So our expectations for the rest of the year is kind of muted returns, maybe low single digits, maybe mid single digits at best. Now that's with the caveat that, earnings have been quite resilient on both sides of the border. That's also specific to Canada. We are watching the trade picture quite closely. So we don't anticipate any significant developments ahead of the renegotiations of USMCA, which is due to happen by mid-2026. So our base case is for the rest of the year. You'll hear headlines every now and then, and certainly we've been seeing Prime Minister Carney really focus on forming new trade partnerships and trade relationships with other countries around the world, which we view as a positive in terms of just diversifying our economy. But yeah, we do think it's not as expensive, but again, it's not overvalued yet. So we expect the TSX to continue to benefit from relatively resilient commodity prices, and also the financial industries, stabilizing in terms of whether it's NPLs sort of moderating. We recognize that the housing market, there are still pockets of concern, so we're watching that very closely. And we are a little cautious on some of the more consumer discretionary facing companies and names because, as we've seen for several quarters now, the Bank of Canada's Consumer Expectation Survey has been showing that Canadians are feeling stretched, elevated cost of living, not quite seeing their wages catch up with that. Now, on top of that, there's a little bit of uncertainty around the job prospects as well as a result of the trade concerns.
What about healthcare stocks in the United States? They've long been seen as a reliable core for a portfolio. The health insurers have had a fairly rough year.
Yes, so we have a proprietary U.S. sector rotation model that we use. It's part of our allocation within the U.S. equity segment of our solutions, our portfolio. And for November, the model actually allocates to healthcare and communication services. So it's interesting that you bring up healthcare. You're right. So healthcare is sort of split out into, you've got your pharma companies, and then you've got your insurers and your benefit managers. And there's been a lot of noise around coverage and what that could mean. So that certainly has weighed on certain parts of the healthcare sector. Recently, there has been some positive developments on the for some of the players in the pharma industry. So you're starting to see a little bit more of a positive tone in healthcare that's showing up. And traditionally, it has been a defensive sector, but we have to always be cautious that there is regulatory risk around certain players in certain subsegments of the healthcare industry.
And he was speaking with Christine Tan, portfolio manager at SLGI Asset Management. Coming up, it looks like Alberta and Ottawa are close to a deal on the future of Alberta's energy sector. We'll find out more right after the break. Prime Minister Mark Carney has touched down in the United Arab Emirates, the first of two stops on his nearly week-long foreign trip, culminating with the G20 Leaders Summit in South Africa. CTV's Rachel Aiello is traveling with the Prime Minister and has the latest on his efforts to diversify Canada's economy in the face of the U.S. trade war.
The Prime Minister has come to this Gulf nation to pitch Canada to wealthy investors and to advance trade talks, but he'll be doing so while navigating some delicate diplomatic discussions. Arriving in Abu Dhabi, the Prime Minister was greeted with a grand welcome. Over the next 2 days, Carney will have a series of meetings with top government and industry leaders to try and attract more capital to Canada. Potentially helping that happen, according to a senior government official who briefed reporters on the plane, the two countries will be signing a foreign investment protection agreement while Carney is here, a pact that's been in the works for nearly a decade. The Prime Minister also intends to launch trade talks with the UAE towards a new comprehensive economic partnership agreement that would make it easier to do business. Last year, Canada's two-way trade with the UAE was valued at more than $3 billion. But the federal government sees potential to expand energy, agriculture, and artificial intelligence partnerships. Carney's time in the UAE also comes as this country is pushing back hard on accusations it's fueling Sudan's war. The Canadian officials expect the Prime Minister to raise the issue along with a series of other security concerns. But that and other frank conversations the senior official said Carney is likely to have here are all going to be happening entirely behind closed doors, as the UAE government is restricting Canadian media access to the Prime Minister's bilateral meetings. Rachel Aiello, CTV News, Abu Dhabi.
And sources tell CTV News the federal and Alberta governments are just days away from reaching a memorandum of understanding on the future of Alberta's energy sector. For more on that, we're joined by CTV's Jeremy Sherrill.
It would be the first stage of a potential deal, just an agreement that they are looking to get a deal done. But what we know is that sources tell us that the two sides are close, within days of agreeing to and signing a memorandum of understanding that would include the focus on a couple of things. The first being a change, an adjustment to the industrial carbon price, which is currently frozen in Alberta. But that would make it or help for the Pathways project to be able to move forward and be financially viable. The other big thing that is being talked about is, of course, support for a pipeline to the northern coast of BC, a bitumen pipeline, which is exactly what Alberta Premier Danielle Smith has been pushing for, and that could include an exemption on the tanker ban for that pipeline project. Of course, the tanker ban has been, a contentious issue when it comes to getting a pipeline project through to BC's northern coast, but the BC government has been adamant that tanker ban needs to stay in place, and completely opposes a pipeline to its northern coast. So that, of course, will be a big challenge. But what we know is that the federal government is perhaps days away. What we've been told by sources is it could be, announced by end of week on that memorandum of understanding with Alberta that has been pushing adamantly for a bitumen pipeline to the northern coast of BC.
And it's going to be tricky. What about Alberta and BC? Could the two of those reach some kind of understanding?
that's going to be the biggest challenge. There's no question. The Alberta government has been very clear. This is an opportunity that would open access to new markets, Asian markets, specifically for exporting Canadian oil. And we know that this government has been clear it is looking to diversify its markets. So I think it's no surprise that the federal government is working closely with the Alberta government to maybe try and push this forward. The BC government is going to be the challenge here. David Eby and his government have been clear. They oppose a pipeline. They believe that there is no proponent. They believe that the tanker ban is crucial and needs to stay in place, and fundamentally are opposed to this project, to the potential of a pipeline to its northern coast. And so the biggest challenge will be in discussions between the federal government and the BC government and the Alberta government and the BC government to try and come to some kind of agreement. The Prime Minister has been clear in the past, Andy, that he would not move forward with any project in a province where the provincial government is not on board. Basically that he would not steamroll a premier to get a project done, because the premier, ultimately doesn't have legal authority to stop a project from happening. But the Prime Minister has been clear that he'll be looking for buy-in from the provinces involved. So that will be the single biggest challenge moving forward, is whether or not there is any wiggle room to be had in BC. And if not, how does this move forward? And how does the Prime Minister move forward? Because if he doesn't move forward with this agreement with Alberta, Premier Daniel Smith is going to be very upset. And if he does, Alberta's or BC's Premier David Eby is going to be upset. So there's a difficult situation that the Prime Minister is left to deal with here. And likely he's going to have to make a very difficult decision.
And that was CTV's Jeremy Sherrill from CTV News. Our market call is coming up next. Today on the show, we have David Burrows. He is CEO and CIO at Barometer Capital Management. We'll be taking your questions on North American large caps. Let's take a last look at the market, see how they're doing today. After the news of NVIDIA earnings beating the analyst estimates, you can see the TSX, it surged to start. Now it's dropped off by about 0.29% right now. And south of the border, they were holding their gains, but now they've turned as well. You can see S&P 500 off by 0.19, Dow Jones down 0.11, and NASDAQ off by 0.34. NVIDIA right now is trading up slightly. And thank you for watching Morning Markets. We'll see you tomorrow. I'm Roger Peterson. Have a great day.